West Australian Newspapers is facing a big backlash from small investors next week when they vote on the deal, which will transform their company into one of the biggest media players in the country and also load it up with debt. The proposal by Kerry Stokes for WAN to buy his Seven Media Group is a controversial one, which has split the investing community, with only 14% of the shares on offer for retail shareholders being snapped up. Andrew Robertson investigates.
After 6 weeks to digest Kerry Stokes' latest corporate engineering, enthusiasm in the investing community is still in short supply.
It's essentially a financial reconstruction of the two assets that are largely owned already by interests associated with Kerry Stokes. There aren't a great many direct operational benefits for either company.
The $4 billion deal will combine Western Australia's dominant state-based media company with the Seven television network, Pacific Magazines and the online portal Yahoo 7. At the moment, Seven Media Group is owned by the Kerry Stokes-controlled Seven Group Holdings, private equity firm Kohlberg Kravis Roberts and a number of smaller investors. To pay for Seven Media Group, West Australian Newspapers will issue new shares which will include a public offer, and it will take on $1.7 billion of Seven's debt. It's that debt which BBY's Mark McDonald believes is a key reason why less than 20% of WAN's small investors have taken up their entitlement in the public offer so far.
The retail shareholders are probably attracted in the main to the very strong dividend flow that historically WAN has provided. Its capacity to do so in the future, if this deal goes ahead, is likely to be much less.
Even supporters of the WAN-7 merger, such as media strategist Steve Allen, have concerns.
West Australian Newspapers moves out of being really a mono-media organisation and a much more broadly based organisation, therefore much less risk over the various advertising cycles, but it's taking on a lot of debt to do it.
Many big shareholders clearly have their worries too. West Australian Newspapers' share price has fallen 16% since the Seven purchase was announced on the 21st of February. Seven Group Holdings, which is regarded as getting by far the better of the deal, has also lost ground. For Brisbane-based fund manager Tim Saville-Innes, the reason is simple. In his view, it's an ugly deal, particularly for West Australian Newspapers.
West Australian Newspapers will be paying $4 billion in enterprise value to get hold of Seven Group Holdings. And in return for that, they'll get an extra $200 million per annum after-tax profit. Now, that's about a 5% return on investment.
Tim Saville-Innes also questions the business case for the deal, noting that the internet will provide only 2% of the merged company's revenue.
Essentially, they're turning a very good media company that has a good position in the West into a very large media and print company, which is in competitive spaces because you've got the likes of Channel 7 and Channel 10 and the ABC and the SBS, as well as all the other print competitors they have.
Channel 7 is currently the most watched free-to-air network, which Mark McDonald believes in terms of this takeover is a worry for WAN shareholders because the valuation of Seven has been prepared on current earnings.
Seven is doing exceptionally well. Its revenue share is greater than its rating share. So it's been able to monetize its commercial success as a competing television network to a degree that is somewhat unusual and I think many might think not sustainable over the long term.
However, for all the perceived faults of Kerry Stokes' latest corporate manoeuvring, Fusion Strategies' Steve Allen makes this point.
And he's a very canny investor. So really, if you invest by wanting to run the shirt tails of a very canny investor, you'd be doing very well.
We'll know next Monday if investors in West Australian Newspapers share that view.